Good morning, everyone, and thank you for joining us. Welcome to our 2022 DB Pensions Conference. This is the final stream of our four-part series covering some of the most important issues facing trustees and pension professionals. You can view the on-demand recordings of our earlier streams through our website. I'm Rosie Phantom, a partner in the risk transfer team at Barnett Waddingham, and I'm joined today by another risk transfer team partner, Simon Bramwell, along with Emma Thomas, a deal manager from Aviva. Today, we're going to talk about the fast track to buyout. And by that, we mean getting pension schemes insured in the bulk annuity market. Before we get into today's content, I want to provide some information about the platform. If you would like to ask a question during the session, you can send this using the Q&A box next to the media window. We want this to be an interactive session and we'll try and answer as many of your questions as we can during the Q&A session at the end. On the icon menu at the bottom of your screen, there are a number of tools that you can use. If you'd like to get in touch with myself or Simon, you can use the speaker icon to access our contact details. Our LinkedIn profiles are there and we'd love to connect with you. If you like what you hear today and you think it might be useful for a colleague, feel free to refer this session to them using the refer a colleague icon. If you experience any technical difficulties, there is some troubleshooting solutions available through the console help guide. And finally, we really would like your feedback from today. The feedback form is located next to the media player. If you click on how did we do today, this will allow you to find that form. We really do appreciate your feedback as it will inform what sessions we want to run in the future. So now into the main session. I want to start today's presentation by sharing with you a story. I've been learning to play a new sport, golf to be exact. And I started by having aspirations of stepping out onto the tee, hitting the ball, watching the ball go right up in the air and then travel miles down the fairway. And I found that the reality of learning to play golf and even learning something new can be a little different. I needed to build a game plan to help me learn how to play, which for me, at least, really does involve me actively thinking, keep your eye on the ball. I've needed to get some equipment, but I tried to focus on just the essentials that would allow me to play. And I've also needed some help. I've had to build my dream team, so building the right team around me to help me identify what to work on and when. Now, I think this prioritization process that I've been through as I've been trying to learn to play golf has some similarities to the prioritization process that pension schemes undertake when they are preparing for a transaction and then going on to complete that deal in the bulk annuity market. We see the same three key elements: needing a game plan, keeping your eye on the ball, and building the dream team. And it's this prioritization process that we're going to come back to later on in today's session. So what are we going to cover today? Well, first we're going to look at what's happened for pension schemes during the year, and then also look at what insurers have seen too. We'll then pick back up on that prioritisation theme to share our top tips to help you focus on what's important when it comes to eyeing future bulk annuity transactions. So now I'd like to hand over to Simon to give the scheme's perspective.
Thanks, Rosie, and good morning, everyone. I'll pick the baton up from here. So I'm going to kick off by looking at how pension schemes have fared over the course of this year and what it means today for those schemes looking to de-risk via a bulk annuity transaction. Now, unless you've been living under a rock for much of 2022, you'll be acutely aware that there have been some significant changes in economic and financial conditions over the last 9 months or so. Indeed, there's been so much volatility that the largely unspectacular world of pension scheme risk management has been thrust into the tabloid headlines. And so with that in mind, let's have a look at how things have developed and what that means for different pension schemes and their buyout funding levels. Now, there are many headlines to choose from, but let's start with what I expect is the most material item, that of rising interest rates. Now, longer term interest rates are shown on this chart in green. So after more than a decade at historically low levels, they've risen rapidly from around 1% at the turn of the year to briefly touching 5% late last month before the Bank of England stepped in to steady the market. And for liabilities linked to gilt yields, this has a huge impact. So as an example, the change in interest rates alone may have almost halved gilt-based liabilities since the beginning of this year. And of course, this doesn't directly translate into how funding levels may have changed. Firstly, schemes of differing investment strategies will have seen varying impacts, and there will have been corresponding falls in the value of the scheme's gilt-based assets. And there's also the pricing of bulk annuities is not wholly sensitive to changes in interest rates, and I'll come onto that in a bit. So, and with the value of gilts having fallen so significantly, we've actually also seen a fall in equity prices over the last year, and that's shown in the yellow line. Now, of course, the level of equities held by pension schemes are generally low nowadays, and that owes to years of steady de-risking. And the change in equity prices doesn't have any impact on liabilities. However, what this does show is that whilst the value of growth assets has fallen, they've not fallen as far as gilt values, and hence schemes holding growth assets will have seen some funding level benefit from this. We may have briefly forgotten about inflation over the last few weeks as interest rates and fiscal policy have dominated the headlines. But of course, it's been rising inflation expectations that have triggered much of the subsequent market volatility. On this chart, we can see the market implied inflation expectations. So in yellow, we've got the shorter term inflation here over the following 5 years. And in green, longer term inflation, so shown over the next 20 years. And in the recent past, you can see that short and long term inflation were broadly similar, implying expectations of relatively steady inflation over the short to longer term. However, this picture starts to bifurcate around 12 months ago, and we can see that whilst both measures of inflation have increased since then, the rise in shorter term inflation has been far more pronounced. And it continues to be very volatile. There's a large amount of jumping around during 2022, both in short and long-term inflation, as the market reacts to new data and actions from government and central bank influence matters. So what does this rise in inflation mean for DB schemes funding levels? Actually, maybe surprisingly, not a great deal, and for a few reasons. Firstly, we can see that longer term inflation, the measure of most importance for pension scheme funding, hasn't actually changed significantly over the last 18 months or so, albeit there's a much more volatility to contend with. Secondly, most schemes are protected from high inflation by the caps that apply to pension increases. So even if inflation rises to double-digit figures, schemes' exposure to that higher inflation are restricted to usually 5% or lower each year. And finally, on the investment side, schemes that have taken measures to hedge their inflation risks will have seen corresponding increases in the value of their assets to protect their funding position. Of course, when considering buyout funding levels, it's not just scheme performance that we're looking at. We also need to consider the pricing that the insurers are offering in the market. In effect, this is the liability side that we look at when assessing a scheme's buyout funding level. Now, this chart shows how pensioner buy-in pricing has moved around over the last 3 years, and I'll take a little bit of care to explain this. A couple of notes to start with. Firstly, we're showing pensioner pricing only. That information tends to be more readily available, and because they're of shorter duration, the impact on pricing tends to be less sensitive to various factors relative to maybe the longer duration non-pensioner liabilities. So what this helps us to show is this helps us look at general trends in insurer pricing and to provide a snapshot of recent pricing and where that might be sitting relative to historic trends. And secondly, I would stress that this analysis is based on information we receive from insurers, and we do test it against actual quotations we receive. However, the actual pricing you may receive will be specific to your scheme, its circumstances, and the views of each individual insurer, which may be different from what is shown on this chart here. So the chart shows estimated insurer pricing as a margin above the gilt yield. Effectively, the higher the margin, the higher we are on that chart, the lower the price to pay to buy out. And what we can see is that aside from a spike in pricing around the start of the COVID pandemic in March 2020, pricing was fairly stable up to the end of last year. However, various factors have helped to improve pricing this year. And for nearly 6 months now, we've seen implied yields around 20 basis points higher than the same period last year. All else being equal, this equates to around 5% lower premiums. Certainly not an insignificant change, and one that, alongside general improvements in scheme funding, has helped push many schemes much faster towards buyout affordability than they may have expected. So as I said earlier, not all schemes will have seen the same picture and the same experience over the course of 2022. And I'll show you some examples to help illustrate that. This first chart shows how the funding level has changed since the beginning of 2021 for a scheme that's had limited interest rate and inflation hedging in place, around 50% on their funding basis. And this may not be uncommon for a scheme that is relatively immature with a higher proportion of non-pensioner members. And for this scheme, we can immediately see a huge impact. In a relatively short period, they've gone from 80% funded to more than 120% funded today. And they've achieved full funding for at least the last 3 months or so. This is staggering, and we've actually seen it in actual client cases where a few months ago we'd be presenting to the client, they'd have an aspiration to buy out in 5, 6, 7 years' time, and suddenly that opportunity has become alive today. Quite rightly, this has triggered these schemes to take action and do what they can to try and lock in these gains and make sure that this positive opportunity doesn't disappear. And we'll come back to this a bit later on. We now show a scheme with slightly more hedging. We've gone from 50% to 75%. And this starts to fit the range of where we think most schemes may be in their investment de-risking journey. Higher hedging brings less funding level volatility, and that's what we see here. Still some significant funding level gains, but certainly less vertiginous than we've just seen for the less hedged example. So again, good news, and given they are more de-risked, arguably less for them to do to be buyout ready from an investment perspective. And a more stark example here for a scheme that's fully hedged on its funding basis. On the one hand, the lack of funding level volatility is proof that the hedging strategy has worked and it's protected the scheme from wild movements in their funding position. But of course, this comes with a trade-off. That protection against adverse funding level movements is that the scheme doesn't then see significant improvements that the less hedged schemes would have seen. And clearly we can speculate that if market conditions had been significantly different or in the other direction, our examples would show a very different picture. We only have to cast our mind back a decade or so ago as buyout funding levels deteriorated in the wake of the global financial crisis. In that scenario, we'd see the well-hedged schemes performing far better than the less hedged. Hopefully that's a helpful whistle-stop tour of what we're seeing from the pension scheme perspective. I will be quiet for a second and now hand over to Emma, who's going to provide an insurer's perspective of what she's seen in the market this year.
Thanks, Simon. So as you can see from the slide, the market has grown significantly over the last 6 years as de-risking comes to the forefront of many trustees' minds. The bulk annuity volume transacted per year has increased from 2016 up to a peak in 2019, then dropped back down and remained reasonably steady in 2020 and 2021 at around the £30 billion a year mark, and this is broadly expected to continue as such into 2022. Around £2 trillion worth of DB liabilities are not yet insured, which far outweighs what has been insured to date. Obviously, kind of, as Simon has touched on, the way markets have moved recently, this liability could be considerably less, but this sort of magnitude gives a rough indication of just how much potential there still is in this market. And market commentators think that the market will continue to be around 30 to 40 billion pounds worth of deals each year for the next few years, so very busy market indeed. However, it will be interesting to see how the market is looking at the end of this year with the changing gilt yields, meaning that pensioner liabilities have come down. It'll be interesting to see where the volumes do actually land this year and whether this is an even larger number of actual deals transacting to compensate for the fact that the premiums are falling. With some very large deals coming to market over the last few years as well, it'll also be interesting to see if this could potentially reach even higher volumes in the next couple of years, with just a few of these sort of really large mega deals contributing hugely to market volumes, and it would kind of only take a couple of those to really sort of push that volume up. As you can see from the graph as well, the market is seeing a large number of deals in 2021, despite the volumes reducing slightly from 2020. This is partly because, as well as some of these very large deals coming to market and obviously market movements as we've discussed, we're also seeing more and more deals at the sub £100 million end of the market completing transactions. So moving on to the next slide. Schemes of all sizes are very much able to transact. At Aviva, as an insurer, we think it's really important to be a sort of a whole of market insurer, and we do see a large range of schemes coming to market from sub £10 million deals right up to large, well over £1 billion deals. At Aviva, we achieve this whole of market approach by engaging with advisors regularly around pipelines for deals to ensure there's capacity to fit in these sort of sub £100 million deals in around the larger deals. We also have dedicated resource for large deals, which means day to day we're able to focus on a wide variety of schemes, including servicing these sub £100 million deals. We do receive plenty of requests at this sort of sub £100 million end of the market, and to put this into perspective, in 2021, around 3/4 of the total number of deals we wrote were in the sub £100 million category. And over the years since the bulk annuity market has been around, we've kind of reasonably consistently transacted somewhere sort of broadly around sort of 30-ish deals each year at this kind of level, which just again reiterates how much activity there is at this end of the market. I'll talk a little bit more later about how schemes at this end of the market can approach things and what they can do to get maximum insurer engagement in this current market climate if they are looking to sort of approach the market for a bulk annuity deal. It may seem obvious from this graph that the larger deals hold a larger market proportion than smaller deals, but what is interesting is that you can see from the last 3 years the market has seen an increase in the number of sort of sub £100 million and sub £500 million deals transacting as more and more schemes become fully funded. And as the gilt yield movements have caused liabilities to reduce, I can believe that this will continue at least into the short term. When the market's really, really busy like it is now, insurers unfortunately must make a call to prioritise cases, as every insurer cannot possibly quote on every deal that comes to market. This prioritisation is typically based upon how well prepared a scheme is for a transaction, which leads us on to the next section.
Thanks, Emma. So what we've concluded so far is that for many, what were longer term plans to buy out has suddenly accelerated and bringing forward a long list of actions to be transaction ready. As Emma has described, it's also a very busy bulk annuity market, and a natural consequence of better funding levels is that the market will most likely only get busier. So how do you prioritise what to do to ensure you can buy out at the right time and at the right price? Now, this is where the input of Emma, I think, is incredibly valuable, and I'll hand over to her in a minute for a summary of what Aviva look for in potential transactions as they decide what to quote, how to resource, and how ultimately to price most effectively. But firstly, a bit of scene setting. So if you're finding yourself in a position of suddenly being fully funded or close to far earlier than expected, our advice is don't run before you can walk. Now, hopefully that doesn't come across as too condescending, but what we're trying to impress here is that there's a lot of work, thinking and preparation that needs to go into a bulk annuity transaction. And even schemes who are relatively well prepared and have seen this coming are likely to have at least a 6-month lead-in time before they can complete a transaction. Now, taking each of the points on this slide in turn, firstly, being able to afford to buy out may be a huge achievement and the result of a large amount of hard work and for some, luck. However, that doesn't mean you're buyout ready. And if I had to use a slightly tenuous analogy, it's a little bit like saying you're ready to buy a house as soon as you've saved your deposit. There's clearly a lot that needs to be done to agree what area of the world you want to live in, the house you want to buy, the price you pay, and so on and so forth. Also, identifying the easy wins. You may have a long list of actions. Some will almost certainly be easier and quicker to deal with. And these could be known issues that have been around for a while that can be accelerated. So an example here might be carrying out data cleansing work that was previously non-urgent, but can be done now with relatively little disruption to the overall process. And some of these actions on this list will be more urgent than others. Some to be completed in time for the initial buy-in transaction, and others that can wait until after the buy-in and in the lead up to fully buying out. Just being able to actually do that exercise to segregate what is crucial for the next 6 months or what can wait until 18 to 24 months time helps to bring some order to your priority making. And finally, getting your ducks in a row. Doing a bulk annuity transaction involves a huge number of parties, and it may be the biggest project your scheme ever undertakes. You will require support from multiple advisors, some of which you may have never worked with before, and you need to be organised as trustees and sponsors throughout the process. So starting to get all of these parties together and getting the governance and decision making right at an early stage will help and pay dividends as the project progresses. So again, I'll be quiet and hand over to Emma because I think we'd love to hear from you on what schemes should be prioritising to make sure they can get the right engagement and ultimately get the best pricing from you.
Thanks, Simon. So as Simon said, being well funded is really, really important, but there are a few other things which insurers look out for when they're looking to make calls over cases to prioritise. So if you're approaching being funded on a buyout basis or have recently achieved this and would like to approach insurers, then there's a few things to consider which will help get maximum insurer interest and engagement when you come to market. So I'm going to start off with a really, probably quite obvious one, but well-prepared data is really, really important. For example, sort of completing data write-outs, things like marital tracing exercises just before you come to market, getting up-to-date postcodes, things like that, and just generally making sure that the data is clean. This just helps ensure that the data provided to insurers and hence the pricing is accurate. And it's worth noting that the data doesn't need to be perfect. Minor points can be sort of sorted out post-transaction during the data cleanse period with the insurer, but it does need to be in good order for insurers to be able to provide reliable and transactable pricing. A legally signed off benefit specification is also really important, and agreeing with advisors sort of benefits to insure and how you would like to treat any discretionary benefits that are within the scheme. From an insurance point of view, any benefits like this need to be codified, so it's important to have these discussions early on and make sure that members will receive the required benefits and that you're happy with kind of what you're approaching the insurance market with. And it's really key, I cannot stress enough, that the data and the benefit specification are kind of prepared on a consistent basis and they speak to each other along with the request for quotation that comes in. This just kind of minimises the back and forth between the insurer and the trustees via the advisors sort of asking questions, things like that in an already really busy market. And I'm sure, you know, the trustees are looking to sort of get the deal done. This just kind of irons out any of those issues early on if everything's kind of joined up and you know, easily understandable. And sort of just trying to include as much information as possible in the request for quotation as well. So including information like about historic liability management exercises or any sort of unusual benefits, anything, or if, you know, there's a linked defined contribution sort of part of the scheme, anything like that. It's just really useful to have that information early on. Like I said, just to make sure that what you're receiving back from the insurers is accurate and kind of the full picture. Getting everyone on board as well is really important. So the sooner the better, really, with that. sort of getting your sponsor and even ultimate parent on board before coming to market, and getting a joint working group set up. So this will have representatives from, you know, the sponsor, the trustees, advisors, that sort of thing. This just gives a really good message to insurers that everyone's working towards a transaction, and just gives comfort that the deal will actually go ahead. And it's really sort of helpful for getting taken seriously when a deal does come to market. We have obviously mentioned funding position already, but if the scheme is in a situation where perhaps funding sorry, isn't quite there, it might be a case of, you know, sponsor top-up being required. So if that's the situation, insurers will kind of pick up on this quite early on in the process, and ask for sort of a letter of comfort or something like that from the sponsor. So again, this is just kind of around moving uncertainty, and if there is any sort of funding gap, just being very clear and open with the insurer about where this money is coming from, and that, you know, there is comfort that the deal is going to transact. Having early conversations with insurers is really important and helpful as well. So this normally takes place sort of a couple of months before the deal formally comes to market. You know, advisors normally pick up the phone and just have a chat with the insurers. And this is just a really good opportunity to get feedback on timescales, the process that you're kind of planning to have, and gauging interest from insurers as well. This is really helpful to set expectations on both sides with both the trustees and the insurer. If an insurer knows a scheme's coming to market, then, you know, they're more likely to be able to fit this in and potentially plan, you know, for future workloads. Obviously, we appreciate that this isn't always set in stone. Things can move around, you know, things come up. But at the end of the day, if you keep kind of having an open, honest conversation with insurers, then it's more likely that they're going to be able to fit this in, rather than getting a surprise when a request comes in, sort of when the market's already incredibly busy. At this point as well, it's also helpful to be clear on the scheme's aims of coming to market and the type of process that you're trying to achieve, whether this be a competitive process or an exclusive process with an insurer. For example, we do see some schemes kind of in the sub £50 million-ish range who choose to go down the route of an exclusive process with an insurer. So this is something to consider with your advisors, and it can just help ensure that you will receive a quotation in a busy market, and kind of gives the opportunity to work closely with an insurer to tailor timescales and help meet the needs of the scheme. It's also good at this point to be really clear about what exactly you're asking for when you're requesting a quotation from the insurers, and what you expect to be included in this price. For example, if there's any data guarantees you'd like to be included, or if you're considering looking at something like residual risk cover. So for a little bit of background, this is an additional risk cover that in some instances trustees can opt to buy, which can cover things like missing beneficiaries, benefit risk. The insurer would work alongside the trustees on a due diligence report to see what would and wouldn't be in scope for the cover, and work out a cost for this. So that's just kind of one example, but it is worth considering these sort of things ahead of time, if it's something that the trustees are looking to do. Other considerations I'd like to just touch on, so scheme assets. So that's obviously a really important one, and as Simon's already covered, you know, the reason why a lot of schemes are kind of getting to this point in the first place, which is great news. It's kind of worth having a think about what assets you do hold with your advisors. For example, if a scheme is heavily invested in sort of, you know, equities, something like that, growth assets, even if they're at the point where they are funded, obviously this can be quite volatile, and insurers might take a look at that and think, actually, whilst the funding level is there at the moment, you know, it's not necessarily de-risked, and are they really in a position to be looking to do a buyout? So it's things like that to have early conversations on, and also if there's any sort of illiquid assets that the scheme holds, might be worth considering if these need selling beforehand. Sometimes there can be a bit of a longer disinvestment time frame on those, which again is just worth sort of embedding into the transaction timescales, so there's no surprises, and being open with insurers as well about that. Linking this back into kind of being clear about the requests you're asking for from insurers, it's really good to think about if you would like any sort of you know, security around the price movement from the point of sort of quotation to actually transacting. So we offer something called a price movement mechanism, or a price lock, which in really simple terms is normally where for a fee the price, the quotation gets linked to a sort of a basket of assets, you know, sometimes basket of gilt, something like that. So the trustees are able to track it from from the point of quotation to the point of transaction throughout sort of contract negotiations and things like that. So this is just one option, but thinking about assets, thinking about sort of forward to premium payment and things, it's just worth having a chat with your advisors whether that's something you'd be interested in. We do see a lot of people taking up that sort of thing at the moment, especially given sort of the volatility of the markets as well. Another consideration is for schemes towards the larger end of the market, upward of sort of 100 to 200 million, is to think about gathering experience data, so kind of information about like deaths within the scheme, exits, transfers out, things like that. A lot of insurers and reinsurers will ask for this at the larger end of the market, so it's worth thinking about this in advance, as it can take time to prepare, but it is key in ensuring that you're kind of getting suitable pricing and giving all the information that's available. The last couple of points I just wanted to touch on, which are a bit further down the line and not perhaps something that you would immediately need to sort out before coming to market, but it's worth just having a think about GMP equalisation methodology. This can absolutely be sorted post-transaction. A lot of the schemes we see coming to market at the moment haven't done GMP equalisation. Some have, but some haven't, and it's not a problem. This can be sorted post-transaction, but it's just worth having a think about, what kind of methodology you'd like to go with and how that fits in with the insurers that you're kind of approaching. And even more further down the line, thinking about how you would like to communicate with members if you are doing a full buyout. It's something that the insurers will work alongside the trustees sort of post-transaction, but just having to think about that messaging and what it means for people, and how you're going to give people comfort around that, which of course the insurer will work closely with the trustees on. So the main point to take away from all this, I would say, if I had to kind of summarise, I'd say having a clear overall picture of what you'd like to achieve is really, really important when approaching the market. Make sure your data and benefits to be insured are in order, and don't be afraid to approach insurers early to gather feedback on the proposed process, because this can really be helpful from all sides. So I'll pass back to Simon now to continue on this section.
Thanks, Emma. That's a really comprehensive, very helpful summary, and certainly a lot for trustees and sponsors to digest as they plan for transaction. Of course, we're here to help and make the buyout process as efficient and smooth and as successful as possible. And as I start to wrap up now, I'll bring it back to the sporting analogy that Rosie discussed at the beginning. Firstly, having a game plan. So the amount of work, planning and preparation you need to do will be specific to your scheme circumstances, but regardless, there is a lot to do. And with that in mind, we'll build a game plan with you that aims to maximise the chance of you being able to complete a transaction in realistic timescales and at the right price. And this will include going through the prioritisation process and being able to draw a line between what needs to be done in the short term and what can wait for later on. And we'll build a project plan around these actions so timescales don't slip and you get to the market at the right time. We'll also work with you to address any training needs, help you set your objectives, and determine how we will do that route to market and work with insurers like Emma. Now, of course, game plans don't always pan out as you may hope, and that's why we say keep an eye on the ball. Things are clearly very volatile and there's always surprises. So monitor your funding position, check how your investment strategy is performing, and be ready to act if things don't go quite to plan as you get ready for transaction. And there may also be surprises, not just in the market, but also within the pension scheme itself. For instance, previously unexamined data and benefit information can sometimes throw up issues that had not been considered before and may require some adaptation of your game plan. And also keep an eye on the bulk annuity market. As we've said, there's a lot going on, and the individual circumstances of each insurer and the market as a whole can certainly fluctuate. Try to be receptive to what you hear from your advisors and just in the wider pensions press more generally. And finally, build that dream team. So a bulk annuity transaction is like no other when it comes to the stakeholders and advisors involved. It really does involve everyone pulling together. And not just that, but a lot of demand is placed on everyone to get the transaction done. And any weaknesses can hamper or frustrate a buy-in process. Therefore, have the right insurers, right advisors for the job, with the right experience, and who are able to work in the manner you feel most comfortable with. And also, this isn't just about your advisors, as Emma mentioned earlier. Having a joint working group between trustees and sponsors can also be very valuable in bringing some nimble decision making, some demonstrable governance, and just ensuring effective progress throughout your project. I'll now hand over to Rosie to wrap it up.
Thanks, Simon. So to bring everything together, so everything really is all to play for. I think this slide just summarises, I guess, our 3 top tips. We see that schemes that are engaged, so as Simon said, monitoring the position, schemes that are carefully planning the route but adapting along the way, taking action when required, are those schemes that are better placed to achieve their transaction objectives. As Simon described earlier, the stage is very much set for schemes to be ahead of their journey plans, which is fantastic news. And that in itself creates more rationale than ever to start transaction preparations and to be prepared. We are expecting that there will be significant demand for in the bulk annuity market, and that in itself is likely to encourage schemes to need to be well prepared in order to gain insurers' attention. And then finally, we recognise that flexibility is important. It's all well and good, as Simon says, having a game plan, but things can and do change. And that ability to flex, to respond to changing circumstances is really important. And we also see that the way that schemes interact with the insurance market, and indeed that insurance transactions actually take place, is likely to flex. And we do see that particularly at the moment as markets are so volatile, as we're navigating these more turbulent conditions. So that is effectively our 3 key top tips: be engaged, be prepared, and be flexible. So with that, I'd now like to draw the presentation part of today's session to a close and move on to the Q&A. As I mentioned at the start, please do send us your questions. You can do this by using the Q&A box next to the media window. And I am pleased to say that we have got some questions already submitted. So Simon, the first one is for you, and it relates to market capacity. What do you see as being the main barriers to substantial increase in buyout volumes?
Okay, I'll take one side of it, Emma. I think helpful to add your view from the insurer's perspective. And actually looking through the questions, this question comes up about 3 or 4 times in different forms, so we'll maybe try and address it in various points. So I think few things to think about along this way as well, that the bulk annuity market has already sort of doubled in size in 5 years. So there's already been a lot of work done in the last 5 years just to get to where it is today. So it's not as though we're at a standing start in terms of growth in the bulk annuity market and taking schemes through the kind of buyout process as well. So there's a lot of work there. Yes, buyout funding levels have improved incredibly, and there's suddenly a lot more demand all of a sudden, but there's a lot of good work and framework of processes all the way through the kind of advisory community, the administration community, with insurers, that's helping to kind of service that volume of demand. In terms of barriers, it will come down to, I suspect administration will be quite difficult. It is one of the most time intensive aspects of a transaction. Delivering advice is relatively straightforward, but actually being able to kind of churn numbers and get through data is time intensive, and it's obviously a market that is always very busy and busier as ever as more and more people become pensioners. So I suspect that will bring a bit of a bottleneck, but also a bit of a release valve that will help to kind of manage demand into the bulk annuity market. There's also just the ability just to make sure that all the clients are getting the right advice to do the right thing. We've got obviously investment advisors need to opine on the investment strategy. We've got scheme actuaries reacting to significant levels of changes in funding levels. So there's lots of bits and pieces that I think at the moment are okay, but might become stretched as more and more schemes. So that there might be an element of just being a bit flexible, pragmatic, and just being patient, I think, as the demand is managed. Emma, maybe just a quick view from how you're coping with or gearing up to cope with this as well.
Yeah, absolutely. Yes, I think as we've kind of covered throughout the session, it really does come down to how well prepared schemes are. I think at the end of the day, the more and more schemes that are coming to market with requests, unfortunately, there is a finite amount of resource to provide quotations. So there does need to be something that kind of differentiates between one scheme to another. And obviously there'll always be things that, certain insurers might have a certain preference for at a certain point in time. But the main thing to control is how prepared the scheme is. And that sort of thing. So I think given that, it kind of is business as usual, really, just with a mind to, having to go down that route of sort of prioritising certain cases at this time. But with regard to sort of the main factors sort of influencing, the constraints around this as well, you've kind of got asset availability, reinsurance availability, which kind of, lead the way for insurers as well. And I think touching on the administration side of things, I think with the market, even over the last few years, I know we are kind of seeing unprecedented levels of schemes coming to market, but I think it has been a very steady growth over the last few years, and I don't think that's going to suddenly sort of go out of control at the detriment to things like administration and general scheme management. I think it's going to continue to be in a controlled way, and whilst also kind of increasing the resource and getting people on board to service that sort of thing for the growing demand. So yeah, that's how I kind of see it at the moment.
Thanks, Emma. Okay, so moving on, we've got a question about how might schemes, finding themselves effectively ahead of their journey plan, how might they take steps to kind of protect the position or lock into as best they can to kind of that acceleration along their journey plan. I think, Simon, that's probably one for you, if you wouldn't mind picking that one up.
Yeah, and I think the main aspect to that is looking at investment strategy and making sure there isn't a disconnect between an investment strategy that might have been more influenced by your funding level movements or either your technical provisions, and if you're pivoting towards locking into gains relative to a buyout position, just making sure there's not an inconsistency there. So, for example, your funding level may move in step with your technical provisions basis, but it might not move to changes to the buyout basis in future. So I think the first step or first course of action, and certainly a lot we're hearing from the investment community world, is that doing more to move towards a sort of investment strategy that follows buyout pricing closer, and that helps then to sort of manage any ongoing sort of volatility relative to buyout pricing. Now, it's difficult to nail down what that strategy should be, but for example, a relatively simple, in theory, change we've seen some clients make is come out of equities and go into credit. That immediately sort of removes the potential downside risk and has moved the portfolio closer to what a buy-in provider or bulk annuity provider may price. So that's one aspect. Another aspect may also be if a transaction is feasible, to do some sort of partial transaction, maybe just on your pensioners. Bit of thought to do around the rationale and what that looks like for the scheme as an investment strategy tool, but that's certainly a way to lock into, say, the the good pricing that we've seen in the insurance market recently.
Thanks, Simon. That's helpful. Okay, Emma, I think I've got a question for you here. So we have one about what kind of things do you see trustees doing in terms of doing their due diligence on the suitability of the insurer? I've certainly seen Aviva present on this at different beauty parades, so I thought this might be something that you could give the audience some insights into.
Yeah, absolutely. So it's usually a case of, kind of like Rosie said, if we have sort of trustee presentations sort of either early on or kind of at the end towards transaction of the process, it's very much something we're happy to cover off in there. We kind of have standard sort of information we're able to provide on that, and yeah, happy to provide information. I think especially on the sort of administration side as well, it's something our team are very happy to get involved, sort of having a chat to trustees and sort of giving comfort around processes and things like that. Obviously we've got lots of information on sort of financial stability, if talking about that side of things as well, that we're more than happy to prepare and have a chat with the trustees just to give comfort, really. Obviously we appreciate that it's quite a big deal, sort of letting us look after your members, so want to make sure that you're comfortable with that and you have all the information you need.
Thanks, Emma. So I think we are hitting upon our time today. So just as I round up, a few closing remarks. So we do really appreciate your feedback. Please do look at the feedback form and do send us any comments, any observations, any thoughts you have regarding today's session, as that process of continuous improvement will help us that we can bring interesting topics to you in the future. We have had a lot more questions than we managed to get through during the question and answer session, and we're sorry that we weren't able to answer them all, but we will send out a wrap-up communication that concludes any of the kind of the key highlights and takeaways on those questions that we didn't get to. The recording of this session will be sent to you via email tomorrow, should you wish to review the content again at a convenient time for you. This concludes our DB Pensions Conference. We hope that you found it informative and useful. Please do get in touch with us if you would like to discuss any of the topics covered in further detail. Thank you for listening, and goodbye.